Good morning from Brazil here. Good afternoon, good night, depending on where you are. We have this talk about financial markets in emerging markets and the impact of COVID. I could see from poll results that I took that about 60% of you have lived for a relevant amount of time in an emerging market. So, and 10% of you they were not sure if you lived in a country that was or not an emerging market. That's reasonable because sometimes some countries are really on the threshold of what that arbitrary classification is or it's not. So anyway, what I'm going to do is to talk a little bit about what the COVID meant in terms of economic impact, which you already heard from some speakers, and I'll go over that with a focus on financial markets and the impact on financial assets and investments. So to start with, just before we go on, since we're talking about financial markets, behind me is the virtual background, which is a view from the windows of the Credit Suisse office in Rio. So that's a lake, and then at the very end of the picture near the ocean is the Ipanema neighborhood. So since we're talking about financial markets, that's it. So I'm sharing my screen with you right now, and this is the first poll that you took, and this is us. And let me first start by classifying markets. Maybe it's not that obvious for everybody that emerging markets are extremely different and heterogeneous, even though 60% of you have lived in one of them. And you can see the heterogeneity in this classification by the World Bank. They call the upper middle income any market with a per capita income between $4,000 and $12,500 per year per person. And you can see that that category by itself is already heterogeneous, and it contains some of the largest and more important emerging markets that you can see there, such as Argentina, Brazil, where I'm at, and China, Indonesia, and so on and so forth, Russia, and Turkey, amongst others, such as South Africa, where you had also a nice talk about the economic impact. Then the lower middle income category, it's between $1,000 and $4,000 income per person per year. So you can see that's already much lower than the previous category. And that includes from big countries, as you can see there in the list, such as Egypt, and India, Nigeria, the Philippines, and others. And then you have the poorer countries category. So those are with an income per year per person of $1,000 or less. And you can see those countries right there. And in particular, I would call attention that in the American continent, the only country that is considered poor or low income is Haiti, which is listed there. All the other countries in North, Central, and South America and the Caribbean are either lower middle, upper middle, or wealthy countries. So with the idea of COVID here is that, as you heard before from other speakers, there are some unstoppable forces. And in particular for emerging markets, the issue of poverty and inequality is serious, very serious, because people live in precarious multi-generational homes. They have poor sanitation. They are agglomerated. Many times, many people in one room, many people in one home, and the homes are small, and they are agglomerated in poor neighborhoods. Healthcare might be more precarious. So you also have the issue of needs. People have to go out to try to make some money. As you know quite well, many people work are self-employed or in informal jobs. They don't have a formal work contract, many people. And that varies a lot between countries with more or less formality in the workforce. But home office is not an option for most people. They have to go out and work. They are in the services industry and so on. And then if they go out, they agglomerate, they have to take public transportation and so on and so forth. There's the issue of youth, the hormones. People need to meet each other. They want to see each other. They want to date. So the population of emerging markets is younger. So there will be more impulses to meet and to look for each other, to agglomerate. And then there's the issue of poor education, or maybe some poor traditions that do not help in terms of the expansion of the pandemic and so on. And of course, there's always denial, and we saw that in everywhere, developed and developing countries. So to give you an example of a picture, here are the highest number of deaths per 100,000 population. And of course, this is a picture of the past. This is not a picture of the last 2 weeks. This is a picture of the accumulated number of deaths over the population. So from where I'm speaking, Rio right now, if Rio was a country, it would be leading the unfortunate statistics. Not right now. Right now, the situation is much better. Field hospitals have been closed. The contagion statistics is coming down. The number of deaths is coming down, but this is an accumulated historical figure. So you can see that Latin America, the Americas in general, particularly Latin America and the US and Europe, were the areas where this has hit very severely. And the responses have been, of course, very heterogeneous across countries. And these are some of the examples of the responses that would affect emerging markets and would affect the attractiveness of the markets. One thing is many governments decided to answer by transferring more money to the poorest people. So here in Brazil, there was a relatively successful program, not free of bugs, but I would say successful, of transfers of money to the poorer people in the order of about 25% of our population receiving these transfers. That's over 50 million people, okay? In a very quick amount of time, having to think that many of those people would live in areas in which they wouldn't see money very frequently. They wouldn't have money going around a lot. So by using the current technology with cell phones and so on, they were able, through state banks, to have these monies get to the people that need it the most. And that was a transfer that was higher than the existing transfer programs for the poor. So in many areas of the country, particularly in the poorer area of Northeast Brazil, the impact has been about 20 to 20% of the GDP of those states. In the wealthier states in the South and Southeast, that impact, depending on the state, was below 5% of GDP or below 10% in some of them. So it was very also heterogeneous across the country. And in the poorer areas in some municipalities, the impact on the GDP of the municipality could have been, in some of them, above 40%. So some people were actually seeing money that they were not regularly seeing. And of course, that made the president very popular in those areas. So transfers, expenditures, such as initially with the healthcare system, buying equipment, respirators, the usual, as you know, and increasing expenditures with medical staff and so on and so forth, but also other types of expenditures, such as thinking about the future. So we will spend money in infrastructure, we will spend money in other types of investments and so on. So different countries will have different needs. And also tax breaks. Tax breaks is another common treatment. You could give tax breaks to people, to families, but also to companies. So they preserve jobs and so on and so forth. So these solutions were different across countries. But when you do that, suddenly here you have an emerging market that, depending on the market, would have little resources that would be already in a poor economic situation, making transfers, spending more money, giving tax breaks, so having a lower revenue to work with. Well, what would that entail? Where's the money coming from? You could have more debt issued. In some countries, such as here in Brazil, we can issue debt to our own people because most of the debt holders of Brazilian debt are Brazilians. So we buy our own debt, which is denominated in our own currency. But in other countries, they have to issue debt denominated in foreign currency. So the foreign currency risk increases. So our neighbors, in Argentina, for instance, we face that type of problem. Some countries would print money, and then by printing money, basically they are working and financing themselves with inflation. And inflation is a very problematic treatment because inflation hits the poor. So the poor are the ones who will suffer with inflation. So governments may be reluctant, of course, to work with inflation, but at the same time, it's an easy solution in terms of how quick it can go. So naturally, I saw a comment in one of the lectures, the people saying, well, that some countries will depend on foreign aid. Well, not every emerging market receives foreign aid or depends on foreign aid and so on. So the larger ones, the wealthier ones, certainly don't. So that's not the issue necessarily for a private market. But how will the emerging markets be able to pay for this treatment, and for how long? And what are the implications of those things? And how does that impact the attractiveness of emerging markets in a financial sense for financial investors? Of course, emerging markets could have departed from a fragile initial condition. High unemployment, economy was not growing, a lot of inequality, weak external currency situations with low foreign reserves. Maybe the market had already inflation, so you would start with high unemployment, inflation, low ability to go into new debt, so on and so forth. So the fragile taxation and fiscal conditions, emerging markets may not be as efficient in taxing. And then also politically, their political institutions may have been captured, as is common everywhere, even in developed countries, by the wealthier, by the more powerful people. So if government, Congress, lawmakers are captured or have a strong ties to the most powerful people in terms of financial power in the country, they will have a harder time taxing the wealthier. So the taxation system might not be as efficient. The taxation system may not tax the wealthier in the same proportion that the poor may be taxed. So fiscal conditions may be difficult, even operationally and politically. The issue of monetary and currency situation I've already mentioned. So you have large emerging markets such as Turkey, for instance, with a serious external reserves and foreign currency situation. Even though it's one of the larger countries, you could have Argentina with serious fiscal problems to begin with. And it's a kind of a historical difficulty that they have with their expenditures and all the implications over their economy. They already had higher inflation, they didn't have very high foreign currency reserves, and so on. The issue of less productive workforce is common to many, many emerging markets. So you have a workforce that's not well educated, not as productive. So in many ways, people would think, well, are we going to rebound? And if unemployment is at above 10%, 15%, or even higher, depending on the market, are we going to be able to reduce it? Well, you know, some countries like here in Brazil, we already entered this pandemic with a high unemployment rate and low GDP growth, and we were coming out of a recession between 2014 and 16 and had grown only about 1% per year after that. So that's not really much for an emerging market with high unemployment. Now we have even higher unemployment, and what will change? Will those people be employed? I doubt it. So that's another weakness. You go in already weak. And then you have the issue, the political issue of populism. Maybe some of the measures to face the pandemic, such as transfers, may have generated some ground for the expansion of populist politicians and their domain over the institutions and politics of the country. But of course, you can't, the money doesn't grow on trees, and you just can't go on with that. You have to stop this sometime, and then what do you do? So the issue of rising populism may be very detrimental to the economic health of these countries. And then you could have more dependence on transfers. And transfers for some countries would be transfers from the government of the country to the poorest people of the country. So you create that kind of dependency, which becomes a political dependency. And you might, how do you remove that? Because that's supposed to be a temporary measure. If unemployment continues to be high, if your economy is not growing. And then you also have the issue of transfers from abroad, countries such as some countries in Central America, some countries in the Middle East that depend more or less, more heavily or not, of transfers of migrants that have gone to wealthier countries that send money back home. And this, for some countries, is important. important. And then you're depending on people who are legally or not in countries which are facing unemployment. So that's also an issue. So I would make some remarks then about this, that many emerging markets will suffer much more than developed markets, but because it's a very heterogeneous category, it will see some markets. Take, for instance, the largest emerging market, China, is coming out very well out of this. And China so far seems to be a clear winner in the rebound, economic rebound amongst the most important countries. But you will have others, other emerging markets that will not fare as well. It seems that some of the larger economies in or emerging markets in Asia are doing better. Some of the larger economies in Latin America and South Africa are not doing that well. And so the rebound will be very different across markets. And I would say that probably has a lot to do with the initial conditions that I just talked about. If you already went in with some frailties, so things are going to be more difficult for you. It's quite obvious, but it's a point. So recovery will be very painful for some of the more precarious countries with poor government support and worse initial conditions. And we could have inflation, we could have currency issues that will hit the poor. And then on the top of this, we already have other problems going on, such as issues with climate. Some countries have violence, wars, or internal insecurity issues that they are affected. So these things are only getting worse with this. And of course, developed market financing or even aid, I would say, would probably become more difficult, more scarce, because there will be greater risk aversion. And maybe many emerging markets will have a worse quality as a debtor, and naturally people will be less willing maybe to buy their debt securities. So with that, I would ask you, Marco, who is helping me with this talk, I would ask you to open the second poll, in which I ask if Brazilian Treasury bonds that still offer an attractive yields relative to other sovereign risk securities. So I'm asking you if you would buy one or not.
Hey, just open the poll right now. We are receiving a bunch of votes. Should we keep the poll open for how much time, Professor? We'll have 30 seconds right now. We have 58 votes.
Well, just a little bit more.
Okay.
Okay.
All right. So I'm going to end the poll right now. So if you want to vote, do it right now. And I'm ending now. Okay, and I'm sharing the results. So 40% said yes. Okay, I'm sharing the results with all participants, but 40% said yes. 31 no.
Okay. So just making a comment about this. So I'm even surprised that 40% said yes. I thought maybe less people would, more people would say no, less people would say yes. But why is that? the issue with debt is when you buy debt, you're actually not really buying, particularly government debt, you're not really buying anything productive, right? You're just buying a promise that a government will pay the money that you lend them for them to use in all of these expenses and issues, even to pay formal debt. So it could be, my point with that is that it could be that for some emerging markets, particularly those which are wealthier, equity may turn out to be less risky than debt. And I mean, please don't confuse risky with volatility. Stocks may be volatile, more volatile than foreign debt. But foreign debt may be, payment may be delayed, may not be done, and things like that, while the stocks of companies, and there are very good companies in emerging markets, still, the companies are there. So that's one thing to think about. I'm not saying this is the case in every case, not at all. But I'm just saying the risk of emerging market securities, be then sovereign or private, increased. Okay, so I'm starting to, I will share my screen again with you. Besides that, there's the issue of future black swans, right? So 2020 saw at least two black swans. One is the pandemic. The other one is the size of the response to the pandemic in many countries was quite surprising. But some other countries, such as Lebanon, saw that big explosion in their harbor. That's another black swan. So maybe black swans will become more common, and others may come, new pandemic, environmental disasters, whatever. My issue here is not speculate about that, but it's just to think, okay, do we still have more ammunition in emerging markets, financial ammunition, to deal with any other black swan? If something comes up in the next few years, the initial conditions probably will be much worse in many emerging markets than they were this time around. So that's another issue to think about in terms of emerging market debt. So debt, sovereign debt is issued to be paid in a number of years, many times 10 years or more. Well, many things can happen in 10 years, and many markets are coming out of this very fragile. In terms of investing, naturally, as I already said, there are many good businesses in emerging markets. There are many emerging markets with large stock markets for what an emerging market is. And of course, there are many emerging markets which are coming out of this in good shape, right? Such as China, for instance, relative to the others, I think it's in very good shape. The issue of the rise of populism that I already mentioned is an important issue for investment, because populism usually means unreliable or unstable rules for the game, particularly for investors in the longer term, such as in infrastructure projects, private equity, and so on. So many times investors may be reluctant to come in. You see the issues of environmental issues are becoming very important. So if the country has problems with environmental issues, they will have difficulties attracting some of the largest investors. And so I believe that investors in emerging markets, be they domestic or foreign, depending on the market, will face even greater risks than they would be facing. So the perspective for emerging markets is that it's hard to take these markets as as a single category and invest in a broad index of emerging markets, some ETF, the type of fund, and you need to be probably more selective. So this is an emerging market index for stocks, the Morgan Stanley emerging markets index. This is an index for the wealthier markets, right? So the ones that have large emerging markets. So you can see that these markets have recovered decently well, even though they are not at the peak as an index as they were back in the beginning of 2018. This is my last slide. It's just to show some more complicated slides. So let me just go through. Just look at the first line of colorful squares. And this is a slide of the asset classes that were on the top first each year, and then for 5-year average of 5 years and 10 years. And then you can see that here in Brazil, we had the blue box appearing 3 times at the top, and then the green box appearing 4 times, and the purple top box 3 times. Well, the blue box are inflation indexed bonds. So bonds were the best investment for 3 years out of these 10 years. The dollar, just foreign exchange, 4 times, and then stocks more recently 3 times. So if we take the 5-year average, the purple box, stocks, comes first with bond indexed, inflation indexed bonds second. But if you take 10 years, the blue box comes first, the inflation index bonds are first, dollar second, and then you go to the very last, the box in the extreme bottom right of the slide is the purple, the stock market. So the stock market is the worst thing on average for an investor here in Brazil for 10 years, but this dramatically changed in the last 5 years. And this change is, I'm not saying it's permanent, but this change is really a big change. It's a break because we went from very high base rates down to a base rate right now, which is at 2% per year. This is unheard of in Brazil. 2% per year. I mean, Brazilians were used to have base rates of above 10%, even above 20% sometimes. So you see that these changes in emerging markets, they can be sudden, they can be dramatic, and that's what I'm trying to convey here, that it seems that there was a major break here in which, for some reason, stocks now are coming up first, which was not really common here all of the time historically, and then in many markets things may change, but there are markets in which there are no stocks, relevant stock markets, and in others the stock market, even though it's okay, it's relatively big, it may not perform as well. So I think for investment in emerging markets now, particularly debt, I am a little bit more cautious about it. Okay, so with that, I'm asking you here in this fall if you agree with this issue, because you have lived in different markets and you would have different views about different markets. So would you agree that for the markets that you know, debt would be safer or equity will be safer? So I'm opening this fall, and Marco, I guess you could open it.
Sure thing, Professor. It's already open. People are voting. So guys, we're keeping the poll open for a couple of seconds. Feel free to drop your votes.
And while we are at that, I think we could start, I'm finished, so we could start going into the questions.
All right, so let's just, so should we keep the poll open?
Yeah, you could keep it open for a little bit more.
Okay, so let's start the questions. I've got a question from Bokan. Does the average income calculation include seasonal or part-time workers, informal work, income of the unemployed, example, social grants, etc.? Or is it is only based on formal permanent employment?
No, it tries to capture informal income. I'm not saying it captures everything because I doubt it's possible, and naturally the quality of these statistics will vary across countries. But no, it's not only formal income.
Okay. I got another question from Seda. Do you see any signs that most known brands will leave China and invest in developing countries such as Mexico and Brazil, or they will go back to their own countries such as USA?
But I didn't understand. Are these brands from China or from other countries? No.
Well, actually, the attendee did not specify this, but my understanding is that he refers to global, really popular, known brands.
Yeah, there could be, and there was already some movement on the part of companies that have moved part of their manufacturing and operations out of China into, let's say, more countries which are more friendly. In the case of the American companies, we have seen these kinds of movements. But I'm not sure that this type of movement which is going on is going to be extremely relevant for countries like Mexico, or so maybe a few countries in Asia may benefit, those which are near China possibly. I'm not really sure there will be a big impact in countries, in emerging countries in other areas such as Africa or Latin America. I haven't seen that.
Okay. And I've got a question from Masha, and she asks you, Professor, well, I'll try to summarize the question because it's a quite large one. So do you think that weak institutions are one of the most serious obstacles stopping emerging markets as Brazil from a smooth recovery?
Yes, I do. I always think that institutions have an important role. I don't particularly think the institutions in Brazil are weak in terms of emerging markets. I would disagree with that. I would tend to think that the institutions in Brazil, in terms of the democratic institutions, this one, are actually quite good in emerging market terms. If you think of emerging markets in general, many markets are under an authoritarian regime, so the institutions are weak. Many markets are very poor, so they don't have the means to support efficient institutions and efficient judiciary and so on. So in terms of independence of the judiciary, functioning of political institutions and so on, I actually think that in the case of Brazil and some other Latin American countries, for instance, and countries in other places as well, of course, in Asia, even in Africa, they do have decent institutions in emerging markets terms. But institutions are always in the way of good investment. If the institutions are very weak, investments may have a tend to just run away, or maybe worse, partner with corrupt governments, and that is certainly not good.
Okay, okay. So, Professor, can we talk about the poll? We got some results. Okay.
Okay. I saw there that many people thought that equity would be safer than debt, and a few were indifferent, and some don't want to touch anything, either debt or equity. Everything could be reasonable depending on where you're coming from. I do have a view that even though equity is quite volatile, equity, depending on the country, may be an alternative, or maybe you just avoid the country entirely, as 9% of the people said. Neither. I don't want any of that. I do tend to think that in countries like Brazil and Mexico and many others that do have decent stock markets, Turkey, and so on, maybe considering equity as opposed to debt, government debt, is an important consideration. Even if you want to consider more safer type of investments, such as, well, a few days ago, I was talking to an asset manager, a very experienced one, and he said, well, I decided to get out of securities for some sort of a nest egg that I set to my daughter that's studying abroad, and I just invested that in utilities. So stocks from utility companies. These are more conservative, but you can think of them as some sort of a hybrid between fixed income and equity. You know, I'm not saying this is a solution. I'm just saying this is one way that an asset manager saw the problem. So I do tend to think that equity should be looked at as a possible alternative to emerging market debt in the few years to come. So I think with that, we could close, and I thank you for your participation, and I hope that this has been somewhat useful for you. So good luck, and have a good remaining EMBA consortium. Bye-bye.